All right, so we'll go ahead and get started with our owner highlight presentation for May 2019. I'm Chris Prevatt. I'm our beef cattle and forage economist at the Range Cattle REC. And today I'll be talking with you about cow-calf management strategies for the bottom of the cattle price cycle. So today we're going to focus more on the cycle that's at play and maybe some of the business side of cow-calf management and the business of the cattle business. So just getting started, looking at some of the things that are really going to impact us in 2019 that we've been really focusing on in our program is the continuation of the spread of the African swine fever that's in China, continues to spread and continues to cause massive losses to the pork industries in Asia. The continuation again of the trade war that we've been discussing for over a year now. And I think of back at this presentation last year, we discussed a little bit about how that trade war might play out. I think a lot of people had hoped for a quick resolution to that, but our analysts at some of our major banks let us know that the likelihood of something a quick resolution on our trade wars was not very likely. The border crisis, again, that continues to have an impact on us, whether we talk about imports or exports of meat proteins. The risk of recession is still out there whenever we think about the length of the current business cycle. So typically our business cycles are somewhere between 5 to 10 years, 10 years being the longest business cycles. And June 2019 will be the 10-year anniversary of the last recession. So this business cycle is going to be the longest that we've ever had. So as that business cycle comes to an end sometime in 2019, 2020, 2021 out there, we'll understand that there's going to be a recession out there. And it's something that happens in economies as risk has been taken and some of those investments don't pay off. So it doesn't have to be an economic panic like it was in 2001 and 2008. It's just, recessions, they're a normal part of our economy. Higher interest rates have been a main contributor to maybe some of the reductions in feeder calf prices and maybe a little bit of slowing down in the U.S. economy as interest rates have ratcheted up. We've had some, so they can't pay as much for our feeder calves, so they can't take as much risk on those calves as because they've got a lot of money invested in borrowed money from our farm credit system. So these higher interest rates they're definitely impacting those preconditioning yards and feedlots that run 5,000 to 10,000 head on borrowed money. Again, just in terms of the U.S. economy in general, we've still got balance sheet write-offs. So even if we don't have interest rates increasing, balance sheet write-offs are still tightening on the U.S. economy. And all these factors are really coming down and affecting costs of production ultimately. And that's something we're going to look at today. Tighter margins. I think that's going to be the theme of, from 2016 to where we are today, tighter margins in all of production agriculture. And one of the big things we've been looking at for U.S. agriculture is weather-related impacts. So whenever we're thinking about the cattle market based on these variables, there's probably a pretty wide range for cattle prices to actually go in 2019, depending on how some of these variables play out. I made this slide for a presentation in early April. We were in the 140s at that time for feeder cattle. So looking at 8-weight cattle in the Midwest. So just Oklahoma City 8-weight cattle, we were in the mid 140s. Well, the first 3 weeks of April, we jumped up and we gained about $150 a head from that early April time period to mid-April. And then over the last 3 weeks, last 3 to 4 weeks now, we've given all that back. So we're kind of back to that same point. So just based off of the volatility that's in the market, there's a pretty wide range that's out there. In terms of feeder cattle right now, we're looking for a 120 to 160 range. And based on how these variables play out, whether we're really optimistic, maybe we can get back to that 160 You know, if things get worse in terms of our global trade and global economies, we probably could get back to the 120s, back to kind of where we were fall 2016. So in terms of looking at the cattle industry as a business, one of the things that we're going to talk about today is just the cyclical nature of agricultural returns and commodity prices in general. So typically, whenever we think about some of our net farm income for agricultural operations, years of good returns are typically followed by years of poor returns because we oversupply the market in many cases, and you know, those prices aren't as high in the future years. So one of the things for us to think about here is how well profitability was from 2006 to 2012. During that time period, there was the same amount of profitability in that 6-year time period as there was the previous 40 years combined. I always just like to add, you know, a lot of farms they're trying to use it as a tax shelter, but in terms of just the economics and the financial of these businesses, there's not going to be any businesses that are going to be failing from paying income taxes over a long trajectory. So whenever we think about the cycle that's really at play, our key factors are really going to be in inventory. So U.S. cattle inventory and feeder calf price. These are 2 factors that we're focused on. So as you can see from the 1988 to we'll do 1996 there, you saw an increase and then a decline in these in feeder calf prices. And at the same time, you saw increases in that U.S. cattle inventory. That increase in inventory, obviously, the higher level of supplies that were out there caused lower levels of those feeder calf prices. So we see this time and time again as we look back over the last 100 years, as obviously supply is cutting demand at a lower point on our supply-demand relationship curve. And that's kind of what we're going to get into today. And as you look at where we are today, as those U.S. cattle inventories have increased, we look back at 2015, 2016, 2017, that's why those feeder calf prices obviously have declined. So that's our relationship. We understand it. How can we use that moving forward from 2015 to 2030 is kind of what we're talking about here. And with those feeder calf prices, we understand the relationship in terms of this is going to be LMIC's, Livestock Marketing Information Center. These are their estimated average cow-calf returns. We see the really good years there in 2014, 2015. The way they calculate their returns, these are just returns over cash costs for what they estimate the average UF cow-calf cost being. So it includes all parts of the United States, including pasture rent, on an annual basis. And again, whenever we throw over cattle inventory on top of these cow-calf returns, we definitely see the same relationship, the same patterns here in terms of lower levels of those cattle inventory correlating with higher levels of estimated cow-calf returns. We see the peaks there back the years that we really like to talk about, 2014, 2015, those low levels of cattle inventory, very high, above $500 a head there in 2014, $300 a head. That's on an annual average there. So that second half of 2015, we really took a dive there. So using this type of framework, what we're looking at is being able to project cattle prices and cow-calf profits during those 4 phases of the cattle price cycle. And this is something we started working on in 2015, and we've continued to add to this slide set in terms of projecting these cattle prices and profits. And so these are just going to be based on projected cattle prices and profit trends over the previous cattle cycles. And so we have cattle cycles going back to the mid 1800s that we've been looking at here. So these cattle price cycle, again, it's gonna be based off of that U.S. herd expansion. So based off of increases in supply and those increases in beef production that we talked about from cattle inventory, from expansion, it transitions to lower feeder calf prices, lower fed cattle prices as well. So typically what we like to say is that herd expansion is going to continue until prices approach what we consider average producers' cost of production. So on average, producers will be at break even, or if they're below average, they'll be at a negative once you get herd expansion out there to the peak. And this is just showing us the length of typical cattle cycles back to the 1930s to where we are today. So our dark blue line there, that's our current cycle. The cycle obviously is in process right now, so has not ended. We're in between the 90 to 100 million head of our U.S. cattle inventory. The big takeaway here is length. So what do we know about past cycles, and what can we say about the length of the current cycle? Typically, our cycles are between 9 to 11 years in length. So, you know, whenever we're thinking about the length of this next cycle, it began in 2015. So we're looking at somewhere out there between 2025 to 2027, this next cycle ending, depending on, obviously, demand's going to have a big factor for that, the length of this current cattle cycle. So that's kind of how we project the length of the cycle, is looking at previous cattle inventory cycles. So here's our 4 phases. We've been talking about the top of the cattle price cycle. That's where, you know, we were absolutely thrilled with where feeder calf prices were at the top of the past cattle price cycle. We've been in this downward price transition for the past, 4 years now, starting in 2015 to where we are today in 2019. We've been looking at the bottom of the cattle price cycle. This actually hasn't changed since we began our projections in 2019, from 2019 to 2021, and then beginning that upward price transition phase. So whenever we're thinking about investments, kind of our focus here is when do we want to be expanding? When do we want to be selling our feeder calves? And kind of base our expansion efforts on our farms and ranches around this type of cattle price cycle model. So currently, this is kind of what we say for our industry average. For the U.S. average, just in terms of, obviously, the top of the cattle price cycle, there were significant profits made by just about everybody. The key to making money in the cattle business at the top of the cattle price cycle is just owning animals. You know, we could have bought any time during that time period of 2013, 2014, all the way back to 2010. We had a 5-year run-up period where owning animals was really the key. So the upward price transition, top of the cattle price cycle, our inventory, any inventory we have is increasing in value. The downside of that is following the top of the cattle price cycle, just like a top of a stock market, you have declines. It starts at the top, and that's where recessions start as well. So we've got this downward price transition that we've been in. There's producers making profits in fall 2016. I would say that there's some losses out there, but overall, it's just been declining profitability since we began this downward price transition phase. There's been some highs where we've been able to get some pretty good feeder calf prices, but overall, nowhere near where we were in 2014, 2015. And it's going to be a little while before we get back to that time period. The good news is you get to a bottom and you start moving back up, and we're going to be back to those price levels. It just, it's another 5 to 7 year time period that we've got to wait probably for those highs. But bottom of the cattle price cycle, on average, there's going to be producers losing significant amounts of money, $200 to $400 a head in some cases if they're high cost of production producers. Some people are still going to be making a small profit. A lot of producers will be at break-even levels during this bottom of the cattle price cycle. Now, the good news is depending on how some of these variables play out, that could be 2019. We're looking at 2019 to 2021 being the low here before we begin that upward price transition where we've got improving profitability in the cattle sector. So basically, we talk about these phases, but how has it played out so far? Well, really, it's played out with a sharp decline, 2015, 2016. We've had seasonal improvements, seasonal declines from that October 2016 low to where we are today. A lot of volatility in there, but mostly it's just been seasonal increases, seasonal declines, and then we're probably going to start that next up period. So the way we talk about it is July 2015 is where we fell off the cliff in terms of feeder calf prices. It continued the second half of 2016. So July 2015 to December 2015, and then July 2016 to December 2016 were just rough months for us. And I think as we move forward in this presentation, you'll see that that's our seasonal, but it was a more extreme seasonal decline in calf prices here. So if we ship those calves in July 2015, July 2016, we were golden compared to the annual average for the year, because the second half of 2015, they fell off $600 a head. Second half of 2016, they fell off another $350 a head. So massive declines there. Using that seasonal price trend and maybe some risk management potentially really would have helped us during that time period. So kind of this is where we're looking at today for projections, being somewhere in that 2019, 2020 period. And then we begin the up phase of this cycle. Once we get really, really far out there, that's when we would be at maybe approaching those highs that we saw in 2014, 2015. You know, just in terms of a really basic way to think about it, we had 5 years up from 2010 to 2015. We've had 5 years down now from 2015 to potentially 2020, and then we'll begin the up phase of the cycle here. So really, that's kind of what we're thinking about as we start analyzing investment strategies, and that's what we'll do next. So based on these cattle cycles, based on profits, based on prices, our industry as a whole has been expanding at a time period where that hasn't really been the most economical investment strategy for them. So one of the strategies that we've been looking at is you know, doing something counter-cyclical. So investing at a time period where it's going to be where our feeder calves are worth the least, so that it's going to be able to use lower valued replacement heifers to potentially sell calves during the highest price time of the year, the highest price time of the cycle out there, 2025 to 2027. So our investment strategy is based on investing at the bottom of the cattle price cycle. Invest when things are low and sell them when they're high. Kind of a value investing strategy that many investors use. Just applying that to the cattle sector. So our strategy number one is survive. And a lot of people, as we get into this a little bit further, you know, it's going to be, you got to have a solid balance sheet, and you got to have cash flow that's really going to help you during this bottom of the cattle price cycle. And then we want to analyze that investment potential. What's the potential been in previous years, and how might that affect us moving forward here? So when we're selling these feeder calves when we're in an upward price transition time period, not when prices are declining or really when they're at their bottom, but selling them on the upward price transition. So really, I think it's very important to understand that, you know, if I'm a producer, high level of management, that's what we run our analysis on. Instead of making a small profit or breaking even during the bottom of the cattle price cycle, expanding during that time period is going to make you incur a loss, because you know, maybe you keep 30 or 40% of replacement heifers to really be aggressive during that time period. So an aggressive expansion during the bottom of the cattle price cycle, your break even would probably be at 20-25%. But if you get aggressive with that herd expansion, you're going to incur a loss. So that's why we talked about surviving and cash flow, because this investment strategy, it's got risk. And that's a portion of value investing, taking on that risk, but having the cash flow. I think why does herd expansion occur the way it does now? That's when people have cash flow. They've got additional money to pay for the things that are needed or required, and this investment strategy requires savings for that later date when there's going to be a small profit or breaking even. So it's counter-cyclical, it takes risk, and it takes investment strategy. So whenever we begin analyzing this investment potential of our herd expansion, we realize that we're not talking about animal science or agronomy, Joe. We're talking about making money. So we're not just talking about the cattle, we're not talking about the forages, we're focusing on the business and just looking at numbers to make our business pay for itself, and change this investment strategy based on our specific needs as we analyze herd potential here. So it doesn't matter what kind of cow-calf operation we're on, we understand that the value of any beef cow to any rancher is going to be the sum of all the net income that's generated from the calves she produces plus her cull cow income. So that's kind of what we focused on looking at it over the past 15 to 20 years is when was herd expansion the most profitable in terms of that net income that was generated from that cow. And then so it made us really think about when do we want the majority of our females calving? Do we want them calving, during that price increasing phase or the price decreasing years of the beef cattle price cycle? And so this is kind of our first thought was, we can do all the right things at the wrong time. It's probably not going to work out so well. It's key for us to make the right investment strategies at the right time in order for us to have that financial success in the cattle business. And so that's why we began looking at this U.S. cattle price cycle. So now we'll look at our 4 investment strategies. We'll look at the 2 best and we'll look at the 2 worst. So our most valuable female owned during the last 15 to 20 years, we looked at our most valuable female owned was going to be a heifer calf that was born in 2006. She was developed in 2007, had her first calf in 2008, 6 more calves between 2009 to 2014, and then we culled her in 2014. Now I'll just share with you that it didn't matter if she had a longer reproductive life. Cull cow values were so high in 2014, the most economical thing we could do with her was sell her for cull cow income. Now, obviously, that's a big assumption because we knew what prices were in 2015 when we ran this analysis and what prices we're going to do in cull cow values in 2019. So that's going to be an individual investment decision. But if we looked at the most valuable female that was owned during the last 20 years, this was the female for us. And so it just shows us how important we talk about cull cow revenue, how important that is to the lifetime value of a beef cow. If that female was 1,100 pounds and we were able to get $1.10 there in 2014, that's a lot different than where we are today in terms of that 1,100 pound female probably being in the 45. If we're at a seasonal high during the year, we might be at 50. But basically, that her cull cow income has declined by more than 50% since this time period here. Now I'll share with you that the second most valuable female was just 1 year later. So it's going to be during that time period where, and this was not a high time period for us in terms of these feeder calf prices. This is going to make us look at, whenever replacement heifers are at their lowest, that's kind of going to be the time where we start looking at value investing. So this heifer calf born in 2007, developed in 2008, that first calf in 2009, 6 more calves from 2010 to 2015. We culled her in 2015 as well. That was just the best investment for us in terms of this time period. We also ran further analysis with further years, but it just generated less total net income for us as we move forward because of that decline in cull cow revenue. Now let's look at the least valuable. And so this is just based on USDA projections. Our least valuable are going to be those heifer calves that were born in 2014. Based on where feeder calf prices are projected until 2020, this is actually going to be our least valuable female, was going to be those heifer calves because they were so valuable there in 2014. They were much more valuable for them to be sent to the feed yard, sent to backgrounding operations than to be developed into replacement heifers in 2015 and then being culled in 2022 here. And as you can guess, the 2015 replacement heifer, as we move forward, this is going to be our second least valuable heifer calf that was born in 2015. Now, the good news is we can start thinking about this in terms of making projections for the future. And really, it really coincides with what we've been talking about in terms of our future projections for investment strategies for 2019 to 2021. It just takes some getting used to. I know I gave a very similar presentation to this at the 2015 Beef Cattle Short Course where the economist is up there saying, let's not expand, let's sell these heifers, and kind of went again with what our industry was really getting down and focusing on at that time period. So how is this going to play out? That's what we're looking at for the next 5-year period here. So as we look at U.S. cattle inventory projections, we've got 5-year and 10-year projections, 5-year projections, obviously more accurate in terms of where we think things are going. Those 10-year projections, there's a lot of outliers out there. But right now, U.S. cattle inventory projections, we project 2019 is going to be the peak in inventory. So if inventory's peaked, then probably in 2020, you would see the, that's kind of why we say 2020 is probably closer to the bottom of U.S. cattle prices. So as we move forward, supply is going to be declining on our U.S. cattle inventory, and that kind of helps us if we think about back to this analysis. Supply is going to be moving backward. So as cattle prices we get to that bottom, we're going to start that upward price transition of this cattle cycle. Then we start looking at this U.S. beef cow inventory. We see the same thing as U.S. cattle inventory, just beef cattle inventory, as well as our dairy herd as well. So declining moving forward from 2019 to 2023 in this projection period. And that kind of follows the same trend that we have in our U.S. cattle price cycle, our phases there. So how does that flow into beef production? Now, beef production is going to be a little bit different. Beef production is probably going to peak 1 year after we see that cattle inventory peak. So beef production, because there's a lag there in terms of culling some of those animals, beef production probably going to peak in 2021, and then not significant decreases, but small declines moving forward out there to 2025, 2027. Small declines is kind of where we've got it right now. Without an additional increase in the U.S. cattle herd, there's just not going to be the additional supplies, as there's some culling going on. As we're getting back to where we've got a little bit older of a herd as well. One thing that is always an important part as we think about beef cattle prices. So before we talk about those feeder calf prices, I always like to show the chart in terms of exports. That's been holding up these feeder calf prices for the last 5 years now. These exports have just been absolute key for us getting into a lot of these Asian markets, specifically South Korea, furthering what we've been able to sell in South Korea and Japan, extremely important for us, as well as Hong Kong. Hong Kong's been down significantly for us this year, but hopefully moving forward, we can get those exports to Hong Kong back up. But in terms of beef imports, supply reductions coming from Australia. So these projections here, imports are going to be slightly lower due to the drought and the flood that they had right back to back there, decreasing their cattle inventory by 2 million head there. That was 25 million, and you lose 2 million head. That's very significant for them. But beef exports from 2018 to 2020 here, still being in an increasing phase in terms of getting these beef exports out. Then we kind of slope off. So in terms of looking at projections, it looks like the demand side of this beef equation potentially not being as helpful as it's been the last couple of years, but still really high in terms of these beef exports. Now, this is where, whenever we're thinking about it on a cow-calf level, this is kind of what we're focused on. This is what we're looking at. So just for this projections, they're for Oklahoma City, they're 5-year projections from 2019 to 2023. 2019 projections were at 146 as these projections were made. And again, they've got the low down there in 2021. And you can see as we move forward, we're gonna be heading in that upward price transition. Eventually, when you get out there, supply, if it's cut enough, we're gonna get back to those 2014, 2015 levels in terms of these feeder calf prices that really got a lot of producers excited, and they saw a lot of profit opportunities there. But for the next 3 to 4 years, are we gonna be back at annual averages that we saw in 2017, 2018? That's not our current projection right now. So it's going to have to take a furthering increase in demand, but specifically a lot more spreading of African swine fever into those Asian countries to really impact meat proteins. So specifically, I just wanted to look at, what was that change dollars per hundredweight, dollars per head that they're projecting from 2019 to 2018. Again, these are annual averages, not any specific point during the year, but basically for the change from 2018 to 2019, $78 a head is kind of what they're looking at. And to 2020, looking at the low from 2018, back at $100 a head. So these are kind of just, for us to be planning for that low. And, we talk about a little bit more about that cash flow. It's really, really important to us in the agriculture sector to be able to have that cash flow for family living withdrawal, or to make some of these fixed cost payments for machine equipment and things like that. So again, this is for a Oklahoma City 625 pound feeder steer. That's what FAPRI makes their projections on. Look, and I just wanted to show you the same trends that we see. If we were looking at slaughter steers coming out of the feedlot, being from 111 here in 2019 is kind of what they've projected as the annual average. We're going to look for a summer low probably in August, and then there'll be a seasonal increase there in the second half of the year. Maybe not as big as what we typically see in that March, April time period, but we'll see some improvement there in the second half of the year after we get to that August low. Is kind of what the seasonal price trend shows us. But again, the upward price transition is the key. Moving from the low back to up to a price levels that we can make some reasonable margins until we get out there 2025 to 2027. We see the same thing whenever we talk about finished products. So finding the same price levels there from 2019 to 2020. So all of these in terms of price levels, in terms of the finished product, following that those seasonals and that cyclical change in terms of the cattle price cycle that we have at play here. So just a couple things to wrap up. The first thing is, feeder calf prices, if they're going to decline, if they're going to stay low, what are some of the things that we can do? The first thing in terms of marketing is just look for, in terms of marketing as well as cow-calf management here, focusing on ways that we can lower that unit's cost of production. We're trying to squeeze out the most efficient use of inputs, and that's going to be whenever it's most critical during the year in terms of feed inputs, in terms of mineral things like that. Whenever they're most efficient, whenever they're most critical during the year, we're looking at reducing waste. This is just going to a tough portion of the cattle price cycle. I said scrutinize capital purchases. I said that some about Ag Expo, and that didn't go over well. Reducing debt anytime that we can, in terms of lowering that unit's cost of production, paying off debt if we already have the cash flow available to us. The other thing is looking at marketing opportunities, enhancing cattle quality, cattle quantity and quality there. So shipping in truckload units, the more truckload units, the more buyers are really interested in getting, a lot of pens together the same day, and shipping economical weights is really key for us as well. We're going to talk just in a moment about seasonal price trends in terms of the months to sell, and potentially risk management for some of our cow-calf producers here. So looking at seasonal price trends, I wanted to share seasonal price trends just based on historical seasonal price trends for feeder calves, feeder cattle, fat cattle, and then cull cows. So just based on our average seasonal price trends, you'll see the max average and then the minimum average, but just the average index here. Our typical seasonal price trend here on feeder calves is going to be that we got to get them out of Florida by the end of August, and before we see that seasonal decline. The one thing to take into consideration here is that yes, the second half of 2015, 2016, it's included in these numbers, but there's also 2010 to 2015 that kind of corrects a little bit of that seasonal change that we saw those years have extremely high increases in that seasonal price index. So the takeaway here is, the earlier in the year, if we can get to those heavier weights a little bit faster, they're more valuable as there's not those feeder calves available in the marketplace. We'd have to be summer calving in order to meet that March, April 600 pound feeder steer there. So that's kind of our seasonal price index for steer calves, looking at 500 to 600 pounds. Looking at heavier weight animals, if we talk about 7 to 8 weight feeder cattle, then we're really looking at a July, August time period being the seasonal high for those feeder cattle. Typically, that second to third week of August has historically been the seasonal high, moving a little bit back towards July the last couple of years based on some of these seasonal price declines. The lows occurring in that January, February time period, and that's just because, you know, the spring calvers out there in the Midwest, the majority of U.S. cattle herds are spring calving. When are they going to get to 7 to 8 weights? It's going to be in that January, February time period. So there's just supply influencing the seasonal price index here. We see the same kind of factors here on our fed cattle seasonal price index. The key being that you're going to have an August or September low, those highs being out there in terms of fall calving. When are those animals going to be finishing? They're going to be finishing during the higher portion of the seasonal price index. They're going to be finishing during the March, April, May time period as we get into the next production season. So selling those fall calves maybe more in that high time during the seasonal price index for fed steers. Utility cows, talked about how valuable they were in terms of selling that cull cow. The worst 2 weeks to sell a cull cow is the last week of October, the first week in November. If we look at the last 30 years, that's typically been the seasonal low for us. And you can see it here in this chart. Once we've got to that, March through August time period, typical period where there's not that much culling going on in the herd. So that's the kind of, we know when we want to stay away. But in terms of adding additional weight, not much value of gain there after that March, April time period in terms of adding weight to maybe some cull cows for us. Wanted to share 3 more things with you. The first one being, I don't necessarily think this is your average cow-calf cost, but the reason I show this is LMIC and USDA. They've compiled their total cash costs for plus pasture rent. The key thing I like to take away from this is just look how costs have increased over the last 30 years for us. It's very important for us to, have an enterprise budget where we're evaluating cow-calf costs and really get an understanding of what our costs are. And as we add that next piece of equipment or additional facilities, understand how that's going to affect our total cow-calf costs as well. In terms of feeder calves, what we're putting on additional weight gain, if we're going to be competitive in the long run, we really have to be putting on weight as efficient as the feedlots are in terms of adding additional weight. So this is our focus on the feedlots, feeding cost per hundredweight for steers. So their cost to gain is about 91 cents a pound. So as we're adding additional weights, we start thinking about taking them to heavier weights, looking at taking them from feeder calves to feeder cattle. We need to be competing with them in terms of putting on this weight in steers right now at 91 cents a pound. We need to be doing it for less than that if we're going to expect really to make some money adding that additional weight. On heifers, a little bit not as efficient, obviously, so cost of gain is going to be a little higher. Putting on added weight to these heifers probably at about 95 cents right now. So again, that's just one of the things I think I try to get producers to focus on is putting on additional weight gain to these feeder calves in their backgrounding or preconditioning program if they choose to, at a cost that's lower than the feedlots are doing it, in order for us to really get paid for our time and for our facilities and effort. Now, in closing, I'll share one thing that one of my colleagues at Texas A&M said, that whenever we think about where the agriculture sector is today, we're at a time period where commodity prices in terms of corn, soybeans, wheat, in general, the majority of farmers, they've been fighting some tough margins since 2012. So he just puts out, he focuses on the big commodities there in terms of row crops. So he's not going to say that all farmers are broke and they're headed for, you know, a 1980s type crash where, you know, there was a lot of bankruptcies and a lot of farmland that went back to the bank. But for the real farmers out there, the farmers that are, you know, they're farming 500 to 1,000 acres, 300 to 400,000 real farmers out there in the U.S., that the likelihood of failure is probably about the same as the likelihood of staying in business. That we really got to be focused on the financial side of things for our businesses. If we're going to get them through this next bottom of the cattle price cycle, you know, bottom of corn, where, you know, we're approaching 350 on corn, and cash corn in some parts of the United States is probably going to be $3 whenever we get to harvest. Soybeans probably closer to $8 is what we're looking at on cash side of things, if things kind of stay where they are. So how have we been able to put this off? It's really been on the yield side of things. Some of the agronomic things have put it off. You know, new genetics in terms of some of the varieties that are out there have really put off a lot of the bankruptcies that we would have thought would have occurred, because they've been able to get these record yields. But the problem with record yields is it increases supplies even further. And so we've got a lot of soybeans in storage that probably aren't going to get to China. We've got to find other markets for them. So in summary, beef cattle market summary, a lot of volatile changes. I think we've seen that throughout 2019 so far. You know, in terms of just April, there's been, you know, we've been a time period where there's a $300 a head move from being down 150 to being back up 150. And then under normal circumstances, if you take all these outliers out of play, we would be looking at lower feeder calf prices for 2019 and probably 2020 as those further increases in beef production and competing meats take place. So I appreciate your attention, and if we do have any questions in the audience or online, I'll be glad to take them. Thank you.
You call that 2015 and 2014 8-year-old cow based just on the value or cull cow value, or was there that you open, or was you?
Yeah.
I mean, if you tell me it's based on the value of the cull cow.
Yes. Okay. So the yes, it wasn't. It wasn't. Obviously, it had been more valuable. So the question is whenever we culled that the calf that was born in 2006, and we culled her in 2014, and then the next year for the 2015 cull, did we cull that animal as a cull cow or as a bred cow? And the answer was the data is for cull cow. So that's what we had the data for, and so that's when we culled her. She had been more valuable if she was still reproductive, that we could have sold that animal as a bred cow, because they were probably bringing another probably $300 to $400 a head. Yes, it was. Yep, to raise more calves, because, you know, that significant decline that you saw in the second half of 2015. And so again, I used annual averages. You could have squeezed one more out of her by selling that calf in July 2015, but since we used annual averages, it was better to go ahead and cull that cow. Yep, absolutely. And we have one more question online. Is how do you predict the weather this year in the Midwest affecting the feeder calf market due to feed costs? And you know, that's a great question that we're looking at right now, is how much of an impact is the weather having on us, potentially reducing the number of acres planted, as well as the number of the amount of yield that we may be getting. But one of the things that we're really looking at is the potential for these genetics that we're potentially able to get in a little bit later and still get a lot of these places planted if the weather cooperates us for the next 30 to 45 days, still being able to get in. And I think the other thing is there's so much yield already in stocks that you know, without significant improvements in export markets for these crop commodities, that we're kind of at a standstill here on the trade war, that we've got to be able to have a place to go with these additional soybeans going forward. So a great question. The last one, how do you expect Brazil to impact U.S. profitability? Maybe we're talking a little bit on this question about Brazil's impact in terms of U.S. beef imports. And, you know, for the majority, they're just going to be importing lower cuts. So they're probably going to take more of the place of Australia's lower quality cuts moving forward. If we look at a really long-term approach, you know, if they improve infrastructure, as we always discuss, you know, they can definitely be a game player if they improve infrastructure and make the feedlots into getting into those Asian markets. But for right now, that's not necessarily an issue or a projection for us. So with that, I appreciate your time, and if you have any additional questions, please share them with me. Thank you.